Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the OPEC and non-OPEC meeting, which will be held on December the 6th in Vienna. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm really pleased to have you here with us. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade on the markets. We will select an instrument such as gold, crude oil, or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis, according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand that it's solely your decision whether you trade on market opportunities or not. So here's an example of a very recent market opportunity. Here you can see fundamental analysis on what's going on with crude oil. You can see, for example, how Saudi Arabia says it will make up for the shortfall in oil in the market due to Iranian sanctions. This could apply downward pressure to crude prices. And as you can see, this is a downtrend opportunity over a weekly period. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price of 69.04 reaches the pivot point that you can see in the center of the screen here, this shows the right moment in our estimation for opening a trading position if you decide to trade on this market opportunity. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit, and further across the screen on the right hand side you have calculations. If you close the position using take profit, you can expect these kinds of profits at those kinds of support levels in green. If the price is going against you, then you could potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. First off, a quick description of OPEC. The Organization of Oil Petroleum Exporting Countries is a cartel of 14 countries that produce and control roughly 73% of the world's oil reserves. Middle Eastern countries like Saudi Arabia are dominant, but African countries and Venezuela are members too. Full OPEC meetings are attended by non-OPEC or OPEC Plus countries also. Non-OPEC or OPEC Plus. So these are countries, most notably Russia, that are not members of OPEC but attend ministerial meetings. And in January last year, an OPEC and non-OPEC ministerial committee was formed to ensure OPEC objectives are agreed. Russian support has been crucial to OPEC since the country is the second biggest crude exporter in the world. Together, Russia and OPEC can move crude prices. So, what makes this month's meeting so important? Well, all OPEC meetings are important and move the markets, but this one is particularly important. The existing OPEC production limitation deal will come to an end this month, and with oil prices crashing to yearly lows just above the $50 per barrel level, there is pressure from many OPEC members to balance the market and push prices higher. The OPEC meeting is going to give the organization the opportunity to discuss and then set production rates, which will influence crude direction in the short to medium term. We will talk potential outcomes in a moment, but it's important to show you how these meetings move the market so you can understand how to trade the meeting if you want to. The OPEC and non-OPEC agreement was signed in 2016 in response to an oil glut that saw the market flooded with oil, driving prices downwards. Russia and OPEC countries agreed to restrict production, and this was extended in November last year to cuts of 1.2 million barrels per day until the end of this month. You can see on the right-hand side of the graph how the price of crude has grown since the OPEC agreement was signed in 2016. These cuts in production lifted crude prices by over 30% over the next 18 months. What kind of impact has OPEC had on oil prices in the past? So let's have a closer look at the market's immediate reaction to the original crude production limitation deal signed by OPEC in 2016. We can see clearly how the announcement of the deal had a direct impact on oil prices, causing a dramatic rise in crude oil, which was up 8.85% by the end of the day. This obviously delighted the traders that managed to anticipate OPEC's move. This OPEC meeting has the potential to move the markets as much. So let's talk a little bit about the current situation. One of the primary factors affecting crude in recent months has been US sanctions on Iran, when the US accused the country of not honoring the previous agreement signed with the US and major EU countries concerning its nuclear weapons program. On the 8th of May 2018, US President Donald Trump announced that the US would leave the nuclear deal that was signed with Iran on 16th of January 2016. He also said to reimpose sanctions that were in place before the deal was made. In the short term, this drove crude prices up. On this chart, you can see that crude hit a 4-year high peak of almost $77 at the beginning of October, marked by the red line. Since then, we have witnessed a steep downtrend, and now crude is trading between $50 to $51 per barrel. But what happened? Oil sanctions and geopolitical instability are supposed to push prices up after all. Well, at the beginning of November, the US announced waivers or exemptions on oil sanctions for China, India, South Korea, Italy, Japan, and Turkey, among other countries. In fact, there were rumors weeks before that the US would allow some countries to continue importing crude from Iran, which accounts for the drop in oil prices, as an oversupplied market drives prices down. So let's take a look at the positions of the three main players in the oil market. Over the past year, US President Trump has been increasingly vocal in his accusations against OPEC. He has accused members of being in a monopoly that is artificially keeping oil prices high, and has demanded that they increase output. This went on for months, and while in the short term his statements affected crude prices, OPEC members and Russia mostly ignored his calls and continued with their own production deal. Despite Trump meeting Saudi leaders or holding talks at senior level with Russia, the two countries will talk about maintaining a balance in production and prices, rather than wanting to increase supply as the US demanded. The turning point was the sanctions on Iran. The US is now the world's #1 crude oil producer at 11.7 million barrels per day, according to the Energy Information Administration. The Russians, like Saudi Arabia, were pretty much in agreement with the view that a barrel of oil around $70 was a good price to aim for. However, in recent weeks, the Russians have pulled back from this position, and despite crude dropping to $50 per barrel, the country's language has been measured. Analysts say that Moscow isn't in a hurry to decrease production and to allow crude prices to grow back to higher levels. In October, as you can see, Russian production was at 11.41 million barrels per day. As for the Saudi position, over the past 6 months or so, Saudi Arabia stated that it was looking for oil prices to trade around the range of $70 per barrel. And when the sanctions began on Iran, the country signaled its intention to increase supply to ensure balance in the market. But the country appeared to resist persistent pressure from the US to drastically increase production. According to industry sources, Saudi Arabia has now raised crude production to an all-time high of 11.1 to 11.3 million barrels per day in November, with the top 3 producers in the world producing record levels of oil and a slight economic slowdown in prospect, decreasing future demand for crude. It's no wonder that crude prices have gone down. So what will OPEC agree? The first point to note is that according to well-placed sources, last week Russia and Saudi Arabia already agreed to a new crude production limitation deal. Russia appears to be happy to let crude prices rise to the $60 level. Saudi Arabia too would like to see oil prices rise. Reports also suggest that Russia and Saudi Arabia have had high-level discussions on the subject at the recent G20 meeting. The question is, by how much should OPEC agree to reduce output? Well, a figure of around 1.4 million barrels per day seems to have had the support of most OPEC countries. A higher figure than this would reverse some of crude's recent losses. But a cut of, say, 800,000 barrels per day or less could mean that crude may fall towards $40. A figure in between could cause crude to continue in its current range or slightly decline in the short to medium term, considering declining demand and the downtrend. Of course, it's possible that no agreement is made at all, which would likely cause a collapse in crude prices, but this seems the least likely option. In any case, OPEC's decision will have a great impact on the future of oil prices. Well, I hope you found this webinar useful. And of course, at ForeTrade, we'll be following developments related to stocks, commodities such as crude oil, and currencies. We constantly analyze factors accounting for price changes, and all of our senior account managers are fully briefed. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForeTrade again soon.